All right, this is for you guys that are looking at either picking up a second home or considering an investment property. You're not quite sure how to structure it. I had a couple of conversations recently with some folks, and I thought it would be great to do a quick video because I figured there's probably more than just those two people that we talked to that have the same question. And so which one is better? If I want to pick up a property and I might use it a little bit, but I also want to keep it as a rental, and maybe I want to do Airbnb or VRBO, some sort of short-term or mid-term rental with it, is it better for me to do a second home or buy it as an investment property? So I wanted to talk through that a little bit. So here's the scenario. A second home has a little bit of an advantage from a down payment perspective. So down payment typically on a second home is about 10%. On an investment property, technically you can do a 15% loan, but to be honest, it's pretty garbage. It's going to be really high in the rate. The fees are high. It has mortgage insurance. You don't want to do that. You're probably looking at something about 20 to 25%. That's kind of the sweet spot for an investment property. And again, 10% on a second home. Now, from a pricing perspective, these two loans price out very similar. They're not that much different. In fact, years ago, they used to be. Years ago, there was a huge advantage to buying a second home versus the rate adjustments that we see on an investment property. But things changed a little bit as we got more and more involved with short-term rentals. Fannie Mae and Freddie Mac decided, wow, a lot of these properties that would probably be considered an investment property, they were picked up as second homes and immediately thrown on short-term rental websites and leased out. And they're not being used actually as a second home. They're really being used as an investment property. So what we're going to do is slow all that down, and we're going to apply a lot of these adjustments to second home financing. So now the interest rate between a second home and an investment property, they're pretty similar. Maybe a small variant, but very similar that way. Now, a couple of things with second home. One thing that you want to consider with the second home is the fact that you potentially could write off some of the mortgage interest on your Schedule A on your income taxes. Of course, you want to talk to your CPA about that, but you've got your mortgage interest on your current mortgage, assuming you have a loan on your primary residence. And then the second home would, as long as you have room in your write-off, your total write-offs, that interest from that mortgage on that second home could also be considered on your Schedule A. Now, if you pick it up as an investment property, you have a Schedule C. And so on your tax return, you're writing off the interest on there, just like you would. It's just done a little bit different than the second home. But you can also write off depreciation, any expenses, travel to get to the investment property, etc. It gives you a little bit more range in terms of a write-off. One other thing that you want to think about is the exit. So most of the time when we're buying one, we're just thinking about the acquisition, but I always encourage people to think through the exit. How long do you plan to own the property? What would it look like when you sold the property? And let's play out a scenario right here where you pick up a second home and you end up renting it just a little bit, but not enough to really consider it to be a full investment property. It's just mainly a second home. When you go to sell that property in the future, you potentially could be up against some capital gains, both with the Fed and with your state. So be careful there because there's not a whole lot of shelter. You cannot 1031 exchange a second home into another second home. That just doesn't work. You're going to realize those capital gains. It's going to hit you on the taxes. There's a couple of really creative solutions for that if you ever want to. In fact, I might film a video on how to navigate through capital gains on a second home, some creative ways to get around that. But it's much easier on an investment property. You could sell that investment property, and assuming that you want to keep that money invested, you could do a 1031 exchange from that investment property to a similar investment property, or split it up into a couple of investment properties. So a little bit more flexibility when you exit the property that way. A couple of other things to think through would have to be like insurance as an example. So if you're going to be doing short-term rentals on it, you definitely want to make sure your insurance company knows that these are short-term or mid-term rentals. They will have either provisions that don't allow them to write that same policy, right, that would exclude short-term or mid-term rentals, or maybe they don't write them at all and you have to seek out a different insurance provider. Now you want to find all that out as early as you possibly can because you don't want to have a situation where there's a claim and you're denied coverage just because it doesn't fit into the policy that you had. You just figured, hey, I got insurance on the house, I should have rights to this claim. And the fact is that they probably had a provision that excluded short-term rental activity on that. So make sure you contact your insurance company for a proper insurance quote. Make sure they know exactly what you're doing with it so that you're properly covered and insured. And then with a second home, something similar with insurance, maybe a little bit easier that way, especially if you're not planning on renting it. But if you do decide this is a second home, I'm going to rent it out when I'm not using it, when it's not in use, then the same thing applies, right? Make sure your insurance company knows what you're dealing with it so you can be properly insured that way. Other than that, I think that's really the key is if you have the extra down payment investment property versus maybe the second home, there's a little advantage from a down payment perspective on the second home, but on the investment property, a little bit more out of pocket. Another thing regarding qualifying. So when you buy a second home and there's no rental income on it, you're qualifying with whatever your expenses are, let's say on your primary, your autos, your student loans, credit cards, etc., and the mortgage payment on the second home. But when you buy an investment property, we're going to run a rent schedule for that specific home. So let's say that home has a mortgage payment with property taxes and insurance of $2,000 a month. We might run a rental schedule that shows that the rental potential on that property is $2,200 or $2,400. Now, as long as that rental potential is really strong on there, we can actually use 75% of that rent, that potential rent, in your qualifying. It's an income that you're not even receiving today, but on paper, it'll actually support you and help you buy that next house. Now, there are some programs that will only look at the rental income on that property. These are called DSCR loans. So as long as the rental income on that property, when we do that rental schedule, is going to be equal to or greater than what your mortgage payment is, that loan's approved. They're going to ignore the rest of your liability side of things. In fact, we're not even going to look at your personal income. We're just supporting that property. That's a really unique thing for investment properties that you cannot do on second homes. So again, just giving you a quick snapshot of what you may or may not be able to do with second home versus investment property. I think it comes down to your personal use case and a lot of planning around that. But that's what we do at the pre-approval stage. So we're talking to you, we're asking a lot of questions on it. Thought it'd be good to give you just a couple of thought-provoking questions and answers so that you can determine which route might be best for you. But if you have more questions on it, reach out so we can spend a little bit of time with you and help you discover that for yourself. All right, guys, until next time, we'll talk to you soon.